Friday, November 27th, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at the stock market and the economy. There are a lot of people, of course, especially politicians, who like to point at the stock market and say how the economy is doing great. So I'm going to try to dispel the myth that a rising stock market in nominal terms, in dollar terms, is a positive signal about the economy. Before I do that today, we'll quickly look at the markets though this morning. It's 8:32 a.m. London. We've got spot gold, 1809. It's down just over $1. Range has been 1802 to 1814. So we're still stuck here in this range. Basically 1800 to 1820. Silver is down 7 cents, 23.25. Down 1/3%. The Dow futures up 55, 29,889. S&P is up 11 points or 1/3%. Nasdaq 100 future is up 1/3 as well. We've got the pound down slightly at 133.55. The euro is up slightly at 119.22, and the dollar is down 1/4% versus the yen at 104.40. WTI crude down 1/4%, just below 45 at 44.80. The 10-year yield is down 1.5 basis points at 0.865. So now let's look at the stock market, the greatest economy ever, right? The unemployment rate, how low inflation is, because those are the reasons given for saying that we have the greatest economy ever, especially in the US, and you know who I'm talking about. Before I do that, let's go through a quote that a lot of times is attributed to Benjamin Disraeli, former British Prime Minister. Google is saying that it was in use before, but be as it may, it's a good quote. It says, there are three kinds of lies: lies, damn lies, and statistics. So let's go through this quick presentation-like analysis that I've done here. The greatest economy, question mark. So on the left-hand side, I've got a stock market index here that is gone through the roof. It's above 100,000. And then on the right, we've got the Dow, which has done well, but not as well as the one on the left-hand side. So you'd think the country where the stock market on the left-hand side should be a great country. The economy should be doing great. It should be at the top of the league. You might think, well, maybe it's China. Well, let's go to the next chart. So here we are. That's the same chart from the left-hand side. Now you've got the name of that index. It's the Bovespa index. What's the Bovespa index? Well, that's the São Paulo Stock Exchange index in Brazil. So you can see how that index is done really well. There was a time where it was below 30,000 there, as you can see in 2005. And then it broke through, went to 70, crashed again to like 30,000. And yes, went up to 120,000 last year, crashed to 60,000. And now we're back up above 100,000. I think it's at around 110,000. So that's the kind of volatility you get here. Is Brazil the greatest economy ever? Has it been the greatest economy ever since 1995? I would say not, definitely not. Is Brazil even a developed country? No, it's still a developing country. It's still an emerging market, even though its stock market is gone to the moon, right? So how come the stock market is doing so well? Well, here's why. On the right-hand side, I've got a chart of the Brazilian currency in dollar terms, and I flipped it upside down. So we have to read it or look at it from the top right-hand side here. You can see how the currency's basically been going down a lot. So that's the key here. In dollar terms, it hasn't been as great a stock market, but we're going to come to it in real terms. And what's real terms for me? Well, it's in the money that's been a stable store of value. How can I say, a great measure of value for thousands of years, a currency, or really money that has measured value back in Rome 2,000 years ago, and it's still worth something today, and that is gold, of course. So here on the right hand side, of course, the real used to get more than $1 for the real. So back in July 1994, that's when they launched this new currency, the real. Brazil, of course, has had many currencies in the last 50 years. There's been a lot of currency collapses, and this currency is not any different. It's going the way of all the other ones, maybe a little slower. So back then, you could get more than $1 for a real. Now you're getting almost 6 reais for $1. So that's how much the currency has dropped. And now we continue. As you can see here, US dollar bought 1 real in November of 1997. So it was 1-to-1, the exchange rate. The Bovespa index at the time was at 8,750. The price of gold, the ultimate store of value, real value, right? At the time, in US dollars, is $297 per ounce, or 297 reais per ounce, because the exchange was 1-to-1. Bovespa index to gold ratio was 29.40, so you needed 29.4 troy ounces of gold to buy one of these indices, the Bovespa index. So what about more recently? I did this as of November 24th, 2020, so 3 days ago. So we've got here the gold price in reais at 9,730. So you can see that the real has been debased, devalued a lot more than the dollar. The dollar is still below 2,000 at the moment, right? We're around 1,800, as we saw earlier. So it's been not only devalued versus the dollar, but it's been devalued even more versus gold, because the dollar is going down versus gold as well. So it's like a double whammy. Is it any wonder that the Bovespa index is at 110,000? The Bovespa index was at 110,080 on the 24th of November. So this is the real test here of the value of the stock market, of whether the stock market is done really well and the economy is doing really well. And I can tell you, even though I haven't been back to Brazil, where I'm originally from, I grew up there for 5 years, things are still not great in Brazil. There's a lot of poverty still. Yes, some people have done very well. The people who've been able to play the stock market, the very wealthy, right? But there's still a lot of wealth inequality, inflation, standard of living is going down. So, and this is why, because the Bovespa index to gold ratio now is at 1028. So as you can see here, the price of the Bovespa index in real terms or in real money has dropped by 65%. So that's how well Brazil has done, really. The business environment, it hasn't done well at all. And that's why people are confused about the stock market and the economy. And I would say it's the same thing for the US. So let's look at the US since 1997, right? Because we did the test with Brazil. And then we'll look at the Dow gold ratio as well, more longer term. But let's look at it from this perspective. So the Dow closes above 30,000 at 30,046 on November 24th, 2020. So yeah, we had a close above 30,000. The president came out and even talked about it. and tried to say, well, we've done great things. The Dow's at 30,000. Well, has he really? And I'm not only blaming him, I'm blaming all other presidents who have used this indicator, statistics also to tell the American people that the economy is doing really well. We can tell by looking at things that it's not. We've seen the long lines of cars, of people trying to get free food, all the unemployment out there, and we're coming to unemployment a little later. So in November 1997, the Dow closed at 7,823, while gold was trading 297. So doing the same exercise I did with the bovespa. So the Dow to gold ratio was roughly 26.34. So yesterday gold closed at 1807. So the ratio was roughly 1662. And I say roughly because the markets close at different times. The currencies or gold moves 24/7. So I said roughly 1662. So here's the test. Since 1997, in real terms or versus real money, the Dow index has dropped 36.9%. So yes, the United States stock market has done better than the Brazilian stock market, but it's still down since 1997 in real terms. That's why it feels weird. People don't understand why the economy is so bad and the stock market is going up, because the stock market is denominated in a currency that's quickly disappearing, aka the Federal Reserve note, that the imposter that calls itself a dollar, because we know a dollar is a weight of silver or a weight of gold, right? That's how it's defined. Not to forget that up until August 15th, 1971, all financial assets were measured ultimately versus gold, because a lot of people, they comment or other people write about it and talk about it. Why are you looking at the Dow gold ratio? Gold is, what's the point? Gold is a commodity. But they forget that up until 1971, indirectly, with the Bretton Woods Agreement, all financial assets were ultimately valued versus gold. And prior to that, before 1934 or 1933, when gold was really money and currency in the US, it wasn't even indirectly, right? It was directly. So just wanted to show you the Dow to gold ratio, a longer term chart, just to show you that the top in the stock market really was in around 2000. I think that Dow to gold ratio was around 44, 45. I'm not too sure. But yes, we dropped to around 7 back in 2011. It has rebounded, but it's on the leg down since I think September 2018. So when do I think is going to be the best time to really buy the stock market in real terms? Well, when that ratio is near 1, and usually it happens fairly quickly, so you need to keep an eye on it. I know we're still around 16. So what about the statistics? Because we're hearing that we've never had such low rate of unemployment, that inflation or CPI is very low, so things are great. Low full employment, we've got stable prices, low prices. I want you to look at shadowstats.com, and you can see that the government actually has tinkered with the numbers. And why have they done that? Well, because of that old comment, there are 3 kinds of lies: lies, damn lies, and statistics. Ever since the 90s, they've tried to embellish the statistics. And I would say 1994, as John Williams said, was a very important year. And why would that be? Well, I think it's because it's when they brought about NAFTA, and they knew that jobs were going to go offshore from the US. So basically, this is what he says about unemployment. alternate unemployment charts. The seasonally adjusted SGS alternate unemployment rate reflects current unemployment reporting methodology adjusted for SGS estimated long-term discouraged workers who were defined out of official existence in 1994. What does that mean? Well, if you weren't trying to look for a job anymore in 1994 and didn't have a job, they wouldn't count you in the statistics. So that estimate is added to the BLS estimate of U6 unemployment, which includes short-term discouraged workers. The U3 unemployment rate is the monthly headline number. So that's the number that we're always told about. That doesn't include any discouraged workers, short-term nor longer-term. The U6 unemployment rate is the Bureau of Labor Statistics' broadest unemployment measure, including short-term discouraged workers and other marginally attached workers, as well as those forced to work part-time because they can't find full-time employment. So prior to 1994, if you didn't have a full-time job, you were considered basically unemployed. And I would say now, people who are also on furlough or on such schemes, they're also not counted as unemployed. So as you can see here, the official U3 unemployment rate, that doesn't include short-term discouraged workers, long-term discouraged workers, doesn't include people who used to earn 10 times more and now have a part-time job, right? So yes, that rate did go to a very low level compared to like 30 years ago. But if you look at the way the government used to calculate the unemployment rate prior to 1994, the broadest measure, we're still right now, even after the bounce of because of the lockdowns and reopening the economy, we're still above 25% unemployment. With their broadest measure, we're still at around 12%. So that's the unemployment picture, really. So I would say that, yeah, there's really 20% unemployment in the United States. And the same thing goes for the CPI. If you calculate CPI, and I've spoken about this, like they did back in 1980, for example, CPI would still be just below 10% instead of the 1 to 2% that we're always told that it is. If you do it through the 1990 methodology, of course, we are between like 4 and 6%. So it's really averaging 5% and not the 1 and 2%. So there you go. That's how they can tell us that we have the greatest economy ever, right? It's all based on things that are not really real. And why do politicians or bankers or brokers, economists keep telling us this? Don't they know this? I think they do, but they're just playing along with the system. You know, they're fooling themselves. And that's why we are in the current crisis where the debt is going exponential. The economy is down the dumps. I know they locked everything down, but even before that, we were approaching very low levels of growth. We had the problems on Wall Street in the repo market back in September. We were running still, not only here in the UK, but in the US, especially 5% deficits. Even before the crisis in 2020, the debt was going exponential already. It was above 20 trillion. It was around 106% of GDP. So that's what you have to ask yourself. If the economies of the world, and especially the United States, were doing so well, how come they had to the government had to run deficit spending? How come the debt levels are so high and unpayable? You would think if you were doing well economically and creating loads of jobs, you would have loads of tax receipts, you wouldn't have a deficit, you'd be running budget surpluses, you'd be able, you'd be able to be paying down the national debt, right? So that's where we get them. So there you go, the greatest stock market and the greatest economy ever. I think it's a myth. If you don't, comment below in the description and tell me why. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. Make sure you hit that little notification bell as well. And you can also follow me on Twitter, Parler, and all these other platforms below here. I wish you all a great day. Take care. Bye.